started. Thanks so much for coming out. Today I'll be talking about financing short-term rentals. It's a common question that comes up is how do I get financing on these? What are the things that you need to know about financing a short-term rental property? So let's get to it. Welcome to the webinar in the heat of summer. For those of you who have been following my webinars, you may have noticed that I haven't been doing the last couple. I actually got married in June. And then I got 2 days back after getting back from our little honeymoon. I got a concussion playing hockey, and it's been 8 weeks now, and it's taking some time to recover, frankly. So it's been a little bit of a recovery. But staring at a screen for an hour, talking to the screen, doing a webinar is not the easiest thing to do while you're dealing with a concussion. So I've had some of my team members kind of cover in for me, and we pushed this one back, and I'm feeling not 100%, but good enough anyways to do the presentation. So it's good to be back. Let's go into the table of contents. I'll be talking about what is a short-term rental, running the business, and some of the keys that you need to think about, how to get financing, some of the challenges that you have with the properties, the financing income part of it, a couple of different options to finance. I'll talk briefly about what commercial financing is, because that can sometimes be an option for these types of deals and properties. I'll do a quick comparison of the different financing approaches, and then talk a little bit about building the empire and how you can do this on a larger scale if that's what you would like to do. I will have lots of time afterwards for Q&A as well. If you have any questions, just pop them into the Q&A, and then right as soon as we're finished, then I'll go over the Q&A and answer any questions you guys have. So this is probably the dream. A lot of you are looking at this and thinking, I'd like a place in Kelowna. Well, maybe not Kelowna right now. It's on fire. Maybe a different property or a different area. But this is often what people think about when they think about a short-term rental. The key is there's obviously a lot of things that you do have to think about, and it should be easy money. You'd think, geez, I can get more money if I rent it out short-term than I would if I rented it out long-term, but not so fast. It's a very different business model than just purchasing rental properties, and it's really important that you understand exactly what you're getting into, because when you do a short-term rental, you're really operating and running a business. And this is an interesting thing that comes up a lot with the lenders on financing. It's, is it kind of like a standard rental property, or is it more like a business financing type of situation? Are they financing a regular residential property, or are they financing more of a hotel or hospitality type of deal? And these are some of the challenges and issues that come up when you're actually trying to get financing on it. And so some of the things that you need to think about when you're running a business like this is you need to think about making sure that you're doing a good job so you can generate positive reviews. You're in the hospitality business, and it's very, very different than just having a tenant that probably bugs you hopefully only a couple times a year for minor little things. You do need to think of marketing and how you can market your property. You need to think about check-ins and check-outs. Every time you have a turnover, there's lots of activity that needs to happen. You need to think about maybe having a website. You need to think about furnishing and designing your unit, which is an important part of being able to successfully run a short-term rental property. You need to think about sales. You're selling your unit. You need to think about cash flow management. One of the things to look at is short-term rentals often are in markets that are really, really good for either the winter or the summer. So, for instance, if you're buying something in Kelowna, you're probably going to get a lot of summer bookings and not so many in the winter. Vice versa, if you're looking at Whistler, you're going to have a lot of winter bookings and not so many in the summer. Maybe you should just buy one in both. Then you have it covered all year. But things like cash flow management, making sure you understand, well, it's not going to be consistent throughout the year. Don't spend all the money that you made in the summer on a bunch of upgrades and then realize that you're going to have a down season in the winter. That the summer really needs to be, stockpiling up those nuts just like a squirrel, saving them for the winter so you can get through that time period, because your cash flow will be negatively impacted during parts of the year. A couple other things you need to think about: insurance. You'll be sometimes surprised to see that the insurance that you currently have will not cover you in the event of short-term renting the property, and there's lots of different insurance coverages, and unfortunately, of course, it's more expensive to get the proper and adequate insurance for the property. So that's really something that you need to look at. Here's a really big one: external government policy risk. We've heard a lot about the affordability issues, especially in British Columbia and Ontario. One of the concerns is what our government's going to do about it. And one of the ways to address the issue of housing is to ensure that there's as many properties in the market as possible. And one of the ways to do that is to remove short-term rentals from the marketplace. And so it's really important that you look into, what is the municipality looking at? Are they putting a lot of pressure on short-term rentals? Are they possibly changing policies? You also have local pressures as well. This could be your neighbor. It could be if you're in a strata building, for instance. A lot of stratas do not technically allow short-term rentals in the building. And so you could have a strata pressures or neighbor pressures. If your neighbor's not happy with you having a lot of people over all the time, or it's always a different group of people coming through your house, then the neighbor could call to the city and complain. So you need to be very, very aware of that. And of course, parties and damage. I think our very first Airbnb that myself and my wife purchased a few years ago, I think it was our second or third booking, where we were on our drive up to go for a hike, and all of a sudden we got a call right before we hit the mountain, and we're told by the cleaner that the guest had a big party, and there's burn marks in the floor, and it was just a complete disaster in the property. And so this is a major issue, and it's something that, of course, over time you get better and better at flushing out these types of things, not taking in guests that may be likely to have parties, and whatnot. But this is where making sure that you have yourself covered. The good news is that depending on the platform that you use, Airbnb, for instance, does have something called air cover, which could allow you to recoup some or all of those costs if having a party in your property. But it's still not fun to deal with, and it still takes extra time and effort to deal with it. So these are some of the issues that you could come up with. Now, the financing side of things, there's a lot of things to watch out for, and a little nuances that are important to keep in mind and to understand. First of all, if you're trying to buy a shack like this and say, yeah, I'm going to Airbnb, it's a great experience, a haunted shed. Very, very hard to deal with something like this. The cabin in the woods that's in a state of disrepair is very hard to finance. So those are very difficult. Now, even this kind of cabin in the woods is still not as easy to finance as you might expect. Depending on the type of property, where it is. For instance, this property could be boat access only, and that could be very difficult to get to, and lenders may not want to finance it because of that. If it doesn't have running power, running water, etc., and general utilities and services that you would typically get with a regular residential house, the more unique it is and the more rural it is, the more difficult it is to get financing in general. So those are things to think about. So some of the issues that we come up to with property challenges would be if it's a cabin or a cottage, the small square footage that you're dealing with, whether it has utilities or not, what the access is. Sometimes the access is a dirt road that doesn't get paved or plowed during the winter, and so it could be considered a 3-season access or 2-season access, which is more challenging to finance. Or of course, boat access only can be more difficult. The location, so the more remote it is, the more difficult it is to find a lending partner that will finance it. The construction type is also an issue or concern. For instance, in the Gulf Islands between Vancouver Island and the Lower Mainland, those Gulf Islands have a lot of unique properties. Some of them are called cob houses, and those are very difficult to finance, as an example. Another thing that's important too is that if you have a fireplace, you typically need to have what's called wet certification to make sure that the fireplace is set up and is safe. It's probably something that you would require for insurance. Banks also need to make sure that they have it. So there's lots of little nuances with cabins and cottages. In some cases, you can still get financing on a cabin that is boat access only and is small square footage. The mortgage insurers have a couple of programs where they can finance cottages and cabins under either type A or type B. Type B means that they'll finance a lower loan amount if it has boat access only, or if the square footage is quite small and it doesn't have all the services that you typically get with a house. But there are some ways that you can get financing, and if you can get insurance from CMHC or one of the mortgage insurers in Canada, it's often easier to get financing from a bank because now the mortgage is insured, so the bank is protected if you default on the mortgage. Resorts are another very popular one. So hotels typically are no-no. There are a lot of properties that are half hotels, half residential properties. Again, lenders still are a bit shy of lending on those, especially because a lot of the time there's a clear distinction between the hotel side and the residential side. And so again, lenders are very cautious about lending in those type of properties. The title ownership is another thing to consider. If it's a quarter share or a timeshare where you don't own the title 100%, very difficult to get financing on that. And typically it's almost impossible to get bank financing in those cases. You need to make sure that you read the bylaws. So some ideal properties for short-term rentals may have restrictions in the bylaws that restrict owner use or restrict the amount that you can rent it out. Sometimes they enforce that you rent it out all the time, except for 30-day owner use during the entire year. Lots of different things to think about there. In addition to rental pools, generally lenders do not like rental pools. Rental pool is when all of the income from all of the owners gets put into the group or the pool and then gets distributed out evenly to everybody. That way, if your unit is rented or not rented, you're just getting an even distribution of the total amount of rental income that the entire pool gets. Banks don't like rental pools because in general, sometimes the agreements that are in that you have to sign in order to be in a rental pool may restrict the ability for the bank to foreclose on the property and to sell the property quickly because of the fact that if it's in a rental pool, then it's booked up and they don't have full access to do what they need to do in a foreclosure situation. So resorts, you have to be mindful and watch out for some of those items. And just in general, you need to make sure that you have strata approval, city approval, and of course, neighbors as well. If you don't have strata approval or neighbor approval, or I should say strata approval or city approval, then you better have neighbor approval, because if you don't have one of those two and the neighbor calls and complains to one of those, either strata or city, then there's a very high likelihood that you could get shut down. So it's really important that you consider the risks of getting into something like this, especially if you're buying in a building where you may not have full access to do whatever you would like to do with it. So a couple of things that come up with the financing, particularly income, is which bucket is an Airbnb or short-term rental in? We talked about this very early in the presentation, but if the lender's lending to you on a cottage and it's a short-term rental property, then is it just a cabin that would normally be financed as owner use? Or if they're trying to use the income from it, then what is that income? It's not consistent. It's not an annual income that is repeatable and is easy to expect. It goes up and down. So the lenders have an issue with what asset class these short-term rentals fall into, and that's one of the issues that they find. Also, if you're buying a property that's going to be a short-term rental, then what income does the lender use at the time that they're underwriting and assessing the risk on the file? The reality is, for the most part, if there's no income on it right now, then they don't know what income to use, and often they just don't want to use any income. There are some workarounds where some lenders will use the market rents as if it was a long-term rental property. So an unfurnished 1-year lease tenant in the property. And of course, that's generally going to get you less rental income than you would if you're using it as a short-term rental property. And so you do need to factor that in when you're making a decision on, can I afford this and can I qualify for the mortgage? If you don't have a lease, then you have no consistent bank deposits, and some lenders like to see that you have bank deposits going into the bank account to determine whether you qualify or not. And of course, you wouldn't have those. One thing that is interesting is if you do have a short-term rental property, and if you've purchased the property and you already own it, and you've owned it for at least one full calendar year, then in that case, you can actually potentially have a higher income on that property to use for future borrowing power. So let me explain this. Lenders often look at a market rents or a lease with deposits going to the bank account, or the tax returns, the T1 generals, to determine the rental income on a rental property. So when you already own the property, and if you've owned it for an entire year, then they look at the T1 generals to see what the income is. The interesting thing is they just look at the gross income, so the total revenue on the property. Now, in general, when you operate a short-term rental, you have more revenue on the property, but then you also have more expenses than you do with a long-term rental. The interesting thing is they just take that top line number on your tax returns and divide it by 12 to get the monthly income, and then they put that in the file. So as long as we're not financing that property, we can often use a lot more income on Airbnbs that are already owned in your portfolio than when you're purchasing the property, where it's very difficult to know what income to use. So this is kind of an interesting thing. Now, keep in mind, let's say that you bought the property halfway through 2022, and currently it's 2023, and so they're going to look at that number and just still divide it by 12, no matter when you bought it. And so If you own the property for only a partial tax year, then they're still taking that number and dividing it by 12. So once you've got a full 12 months on the tax returns, then and they're dividing that by 12, they often get to use a higher income for you as opposed to a lower income for you, which can definitely help with your borrowing power on future deals. So refinancing a vacation rental can be very challenging because lenders don't like to finance vacation properties or short-term rentals. And so if they know that it's a short-term rental, then it's very difficult to get financing on it. So any properties that you already own, if you want to refinance it and the appraiser goes in there and it says, welcome, the Wi-Fi password is this, welcome to the crow's nest. Very difficult to get financing on a property that's evidently an Airbnb, especially when the bank says, okay, just send us your leases. And you say, I don't have any leases on the property. Okay, just show us the bank statement showing the deposits of the rent. I also don't have those. So it can be a lot more challenging to refinance these types of properties in the future. Now, that being said, of course, the Green Mortgage team is here. There's always options. There's always ways of getting financing. Sometimes you just have to get a little creative to get the financing arranged. So there's a couple of different routes that you can take. First of all, it's important to understand you're buying either an owner-occupied property or a second home or buying a rental property. If you're buying a second home, which means that you're basically just using no income qualify, it's often easier to finance the resort style properties where it's hard to show and hard to prove what kind of income you could be earning on the property, like a cabin or other property like that. This is commonly the way to get financing on those types of properties. And it's just usually the way to go for those. If you're buying a rental property, some lenders will use the market rents if it was unfurnished and on a 1-year lease. But some property types may not qualify as a rental property, especially if when they read the bylaws, it might say that, hey, you have to short-term rent this property because of the bylaws of the city or the area or the strata, etc. Now, sometimes if you can't use an income in order to qualify underneath this program or underneath the second home, then sometimes having a high net worth or using a self-employed program can help alleviate these types of issues. Another method is using small business or commercial. So both of these are now looking at from the business case. And you can do this based off of the short-term rental income. They'll look at a 2 or 3 year past history with you as the owner or manager. So it's still difficult if you're buying an existing property and you don't have any experience managing these types of properties before. But if you've owned it and run it for a few years and you have good, strong financials for the company, then it may be possible for you to then get financing with a small business or commercial lender. One of the other benefits too is that when you get small business or commercial financing, these mortgages don't report on your personal credit bureau. They are not personal loans; these are business loans, and so it's a very different type of structure to get this kind of financing arranged. So if you look at commercial and how commercial works, they're usually looking for what's called a debt coverage ratio or DCR. And what this means is that if you had a property that generated $125,000 of income, and the operating expenses like the property taxes, strata fees, etc., was $50,000, then they would lend to an amount where the mortgage payments do not exceed $50,000. So what this means is that in this case, $125,000 of income, they would make sure that the expenses, including the mortgage, are no more than $100,000 a year, because that would be a 1.25 to 1 ratio of income to debt. So they reverse engineer the maximum loan amount that you can qualify for based off of the net operating income of the asset. And the interesting thing with debt servicing is that they use the rental income, but there are also some ways where you can use corporate guarantees as well, which is a kind of a unique thing. So on the rental income, they prefer leases, but sometimes you can use the market rents. But if it's a short-term rental, then that's where usually they're looking at the financials of the property that you're financing. If your income is not strong enough, then sometimes you can use a corporate income to help. So if you have an operating company that's earning a surplus of income, you can sometimes increase your borrowing power by using that company to guarantee the loan. And this is something you can do in small business or commercial lending. So it's kind of like if you're buying your first home and you can't quite qualify for it and your parents guarantee your mortgage. They're guarantors and they co-sign for you. The same can apply where your company can guarantee the loan. So another corporate entity can then that with positive cash flow, of course, can guarantee the loan in order to help you get a larger financing amount. So this can be a potential option for you. So when you're calculating this out and looking at the corporate guarantee, using the operating company to help support the cash flow could be a way of you being able to do this. And some people, what they'll do is they use the corporate guarantee while they're building up the short-term rental. Then eventually, once the short-term rental can stand on its own, then they go to apply to have the corporate guarantee removed, and then now their company is free again of those quote-unquote shackles. If you wanted to compare the difference in commercial, small business, and residential financing, the qualifications for commercial are mostly based on the property. Small business, again, mostly based on the property, but a bit more of a hybrid. And then residential is almost purely based on the borrower themselves. The rates, you're going to see that rates do vary substantially depending on the situation. In commercial, you can often get cheaper interest rates when you're going CMHC insured financing. In fact, even 5.79 is probably high for a CMHC insured mortgage. However, in CMHC insured for multifamily properties would have to be over 5 units. And that's usually when you're buying an apartment building of 10 or 20 units, and it's a very long process to get CMHC financing. But you can even get better rates than 5.79. So it's probably the cheapest kind of financing you can get out there is multifamily insured financing, because that's one of the ways that the government is trying to create more affordable housing, is to push more money into the debt side and offer better financing terms for investors to buy multifamily properties. If you're looking at small business lending, then usually it's a little bit higher than residential mortgage rates are. And then for residential, the low interest rate that you see there, 5.39, that would be best case scenario, you buying something with less than 20% down payment and taking a 5-year fixed rate, which is not necessarily what we recommend right now. But it is important to note that when we're talking about second homes and vacation properties, you can technically buy a second home with as little as 5% down payment, which people don't often realize. And so you can actually get a very competitive interest rate if you were to do that and buy with as little as 5% down. It's just that it'd be very difficult for you to qualify because you have to carry your own personal mortgage and personal debts. And then you're also buying a vacation home that has no rental income coming in. And you're also borrowing, if you're putting 5% down, then you're borrowing 95% of the property value, and you can't get longer than a 25-year amortization. So it's difficult to qualify in those situations. The loan to value, so the lending amount that you can get in commercial, it really varies because it depends on the amount of income that the asset earns and produces. So the loan to value, in most cases, I'll say that usually you're getting 50% financing or less in the majority of cases I see in commercial. Sometimes we can get higher than that, but in many cases it's 50% or less. So just be prepared to maybe put more down payment. On the hybrid approach, you can get up to 80, but most small business lenders are 75% maximum. On the residential side, is up to 80% for uninsured. And technically, you can go all the way up to 95% if you are buying a second home and wanting to go the insured mortgage route. On the fee side, commercial lending, you're typically looking at about 0.25% to 1% of a lender fee, and about 1 or 2% for the broker fee, depending on the size of the loan. Small business, usually 0 to 0.5% for the lender fee, and then 1 to 2% fee for the broker. On residential, most of the time, there's 0 lender fee unless you're going to a B lender or a private lender. And the broker fees for residential, typically, there's also no broker fee. Only in some cases will there be a broker fee in more rare cases. And then appraisals, legal fees, etc. You're going to be looking at minimum $5,000 on the commercial side, but usually more like closer to 10 or 15 and all in. For usually small business and residential, all in, it's usually more like $1,500 to $2,500. And then company name versus personal name. If you're buying commercial property or buying properties through the commercial financing route or going through the small business route, company name is totally fine. If you're going the residential route, then a lot of lenders don't like to finance properties that are held in a company name. Some lenders will, but in general, a lot harder to get financing. So as far as the financing is concerned, there's lots of different routes to take here. And frankly, it really depends on the borrower and the type of property that they're buying. So it's really hard to just say that there's one size fits all when you get the financing. The other thing that you also need to consider here too is when you're looking at trying to set up a short-term rental, there's a lot of things that you need to consider and look at. A couple of the lessons that we've learned is that the design does matter, it sells, and the durability is also very important. So you have to find this fine balance of finding things that look good, but also making sure that the durability is good. So something that I learned, which is kind of interesting, but if you've ever wondered why hotels usually have really bad looking carpety type of stuff on the walls, and then there's usually a bit of a rubber bumper kind of halfway up the walls. That's because if they didn't have that carpet and then that bumper, they would have so many scuffs on the walls because people bringing in their suitcases, etc., and just bumping into the walls, or themselves bumping into the walls. There'd be so many scuffs that you'd be repainting it over and over and over again. So instead of having to do that, yes, it doesn't look as good, but the durability matters. So you have to find that fine balance of design and durability when you're dealing with this, because you do have a lot of turnover and in and outs. Also, automation is really nice too. Ideally, trying to set up a keyless entry type of system, something where you can have a key that gets set up for each guest, and the key expires as soon as they leave the property. You can set that kind of stuff up through a PMS, a property management system. We've been using something called HostAway ourselves, which allows you to use multiple different platforms. So you can, on HostAway's platform, it allows you to take in bookings through Airbnb, VRBO, Booking.com, direct through Google, direct through your own website, etc. And it unifies your calendar, and it unifies your chat inbox as well with all the guests. So it makes it a lot easier to manage the property, especially if you're trying to use a number of different platforms to market yourself. And the other thing is really important: communication. When people are looking at a property at night and they have a quick question and they send you a message, if you don't respond fairly quickly, then they're probably just going to look and book something else. And so speedy replies is really important, and just customer service in general. Again, you're running a business, you're in the hospitality business. What do you expect when you go to a hotel? You expect hotel service. Now, when people go to a short-term rental like an Airbnb, they don't quite expect that, but it's pretty close. You'd be surprised. People tend to expect the hotel service without the hotel prices, which is really fun, because now it's hard to deliver that. One last thing I'll mention that's not on the slide is cleaning. Cleaning is like the number one challenge, I would say, for most people that run short-term rentals. It's very hard to find cleaners. I would expect that because of COVID, cleaners weren't going to people's homes and cleaning, and so a lot of people that were cleaning homes left the industry. And then as COVID was starting to become less of a factor, then everybody's traveling and going to short-term rentals, etc., and it's created this shortage and an imbalance of demand and supply of cleaning. And what's caused this, or what's the outcome of this, is that now cleaners are charging a lot more, and it's harder to find good cleaners. Don't be surprised to be paying $35 or even $40 to get cleaning done. If you're using a professional company, it could be much more than that too. So something to keep in mind is the cleaning is very expensive, and it's only gotten more expensive over the last year or two. So make sure that you understand that. If you're going to go out and hire your own cleaner, you need to make sure you have more than one cleaner, unless you are prepared and willing to go clean the property if the cleaner doesn't show up, because trust me, that happens way more than you can imagine. So a couple of lessons. Oh, I don't know why this slide is repeating itself. I'm going to fire through this. There we go. A couple of things to just to show. This was our first Airbnb that we did up in Langley. I bought 2 pre-sales in Langley. Decided when COVID hit, we were closing on them, I think April 30th, 2020. Didn't really want to keep either property, but decided, okay, let's just sell one of them, and then let's keep one as an Airbnb. So my beautiful wife designed this. I cannot make things look pretty, and this is where she comes in. A couple of little things that we noted. The property in Langley was close to a equestrian center, and so I think it's the Thunderbird Stadium, I think it's called, or Thunderbird something. And so one of the things that we did then is we tried to model the unit and make sure that we have a nice horse photo in the unit, and then it also spurred people to say, "Oh, are you guys close to the Thunderbird Stadium?" And so we do have a lot of guests during certain times of the year that are looking for that. And what we actually do is then we go in and we look at when the Thunderbird Stadium events are, and then we increase our pricing, because we know that we're going to have guests that are very interested in staying in our unit. And people that can afford horses can definitely afford your short-term rental. So one of the lessons there was just to try to figure out what amenities and why people will be coming to your location or your area, and then try to model your unit around that, because you're trying to deliver not only a stay, but an experience. Another thing that we did is we bought a 7-unit building in downtown Victoria. We've been operating that. That is a short-term rental building for, I think we've had all of our units up and running since last May. And so that's been a really fun exercise. We have 6 different units up and running, and each of them has a different theme. So we have one that's a Chinatown theme, and that's what that unit would look like. We have a Indigenous suite, Parliament suite, a Navy suite, garden room, and the Orca pad. And so the same applies. We wanted to look at why would people be going to Victoria, and what are some of the top top sightseeing events, etc., in the area. And then we model that after that. So a lot of people would say, "Oh my gosh, I'm coming to see. I hope to see orcas. I'm doing the whale tour, and I saw your orca pad. That's awesome. I want to stay at your unit." The garden room, for instance, there's the I'm forgetting now the name of the orchard, or not orchard, but the flowers that they have there. So there's another event that that comes up in the spring every single year, in Butchart Gardens. That's what it is. So Butchart Gardens, that's one of the reasons that we modeled a room after the garden room. So trying to just go after different themes and try to attract people based on those themes. So just a couple of photos, like the before and after of the Chinatown room as an example. And this one is the Orca pad, which is probably one of our more popular units. And I think one of the lessons that I think we probably would have applied after, or thinking about, is trying to come up with a theme, but also not taking away from it just being kind of regularly stylish. So here, just a black and white unit is generally appealing in general. And then we just had a bunch of orca photos up, and a couple of little things to go after the orca theme, but not going too heavy with it. So overall, that was our experience with that. And just another photo of the Chinatown room as an example. Oh, and the garden room too. There we go. So yeah, so happy to share any thoughts on that. We're not definitely by no means experts on that, but we're just sharing our experience and what seemed to work and what seemed to not work for us. We do have some tools that can help you as well, because I was looking at different Airbnb or short-term rental opportunities. I just basically modified my cash flow spreadsheet to be more suitable for short-term rentals. So now it breaks down the income component into the low, high, and shoulder season, and then you put in different rent amounts, and then different vacancy amounts for the different times. And that way, it makes it a bit easier for you to calculate your income analysis. We also have a commercial analysis tool. We have our investor kit, and of course, we have our monthly webinars. This is just an example of what our commercial analysis looks like. And last but not least, this is something that's getting announced. I think we're sending out the email next week. But I'm just so excited. I can't hold back. But this is something that we'll be sending out some more details on. But it's effectively a system that we've developed that allows us to underwrite and assess your options with 32 different lenders without you needing to send us any documents. You literally fill in an online form, punch in what you think your credit score is, so you don't even have to provide a credit score, and it'll actually tell you all of the different options that you have, and what your debt servicing is, et cetera. So we can very easily assess your options without you needing to go through the whole process. And this is something I actually took a concept that I've been using for quite some time now, just a regular spreadsheet that underwrote for 6 or 8 lenders, and expanded this in a very drastic way. And we're turning this into software, and we're going to be launching that out to all of our Green Mortgage clients as of next. I think the email is going out next Tuesday is when it's slated to go out. So I'm very excited for this. It's very cool, very unique, and something that doesn't exist on the marketplace right now. So it saves both our borrowers and ourselves a lot of time, instead of having to go through hundreds of pages of documents just to let you know if you might qualify or not. It can fast track that process substantially. So if you have any questions, you can feel free to contact us, info@greenmortgageteam.ca. You can call us at 604-229-5525. Our office is in Vancouver. This little button here is actually, we've moved our address. The address is correct at Granville Street, but we're actually now just across the bridge. So feel free to pop by and say hi anytime. And what I'll do now is it'll open up for questions and make sure that you guys get all your questions answered. This is a topic that usually a lot of people have questions about, so I'm happy to answer those. All right, so I'll go into the Q&A now. All right, question here. I recently purchased a short-term rental property with a TC1 zoning. Every A and B lender turned us down. I ended up going with private lending. This is not a long-term solution. What do you recommend when the year term is up on the private lender? So interesting question. It really depends on what the TC1 zoning allows for. And sometimes there is a lender that will do it. Sometimes it's a credit union. So really it's a case-by-case basis. If you send me an email at kyle@greenmortgageteam.ca and just give me some more details. Maybe if you have the MLS listing from when you bought it or an appraisal or something like that, we can do a quick investigation and look into it. Generally speaking, relies on the usage allowed of the property. So that's really what it comes down to. And sometimes it's heavily restricted and very difficult to get financing. So it really depends. Awesome. So Karan Veer asks, how do we access the spreadsheets? Send an email to info@greenmortgageteam.ca. You can also go to our website to get access to them. But if you just send an email, that would be easier. We'll send you a copy of the spreadsheets. Mel asks, curious if you have any pricing services to maximize revenue. Yes, we do. We're using something called Price Labs. So Price Labs plugs into our property management software. And what Price Labs does is it looks up metadata. So it looks at how many searches are going on in the market right now, how many bookings are going on in the market right now. Are there any events in the area or in the market? So our Victoria Place, perhaps there's a big, huge concert or event the next weekend that we didn't know is coming up. It will actually increase the pricing to adjust for that. Also, if the market is really, really slow, there's not a lot of bookings happening right now, then it'll inch your pricing downwards to accommodate for that. So you can kind of set a bit of a bandwidth, and then it automatically moves your pricing dynamically based on that. So you just set kind of an overall baseline of where you'd like to be, the high and the low, and then it tries to move around that. But we found that that's pretty useful for sure. Rachel asks, is there any advantage to utilizing a HELOC over traditional lending from a business or tax perspective? Not really. There kind of is, in the sense that when you borrow money to invest, the interest portion of the payments is tax deductible. And if you're using a HELOC, then all of the money and all the payments are interest, which means all of it is tax deductible. And so in theory, you would say, well, it makes sense for me if I have other non-tax deductible debt that I should be paying down. I should just pay interest only on my tax deductible debt, because then I maximize my my tax deductions because I'm not paying down that debt. So my interest cost never decreases over time. And then just using all that extra cash to pay down my other mortgages that are perhaps not tax deductible, like your personal residence, for instance, might be not tax deductible. However, to do that, you're also paying a premium on the mortgage. And so right now you're getting kind of double hit, because number one, a HELOC is generally prime plus. Most of the time it's prime plus about 0.5%, which currently today, it's crazy to say this, but prime is 7.2, so it's 7.7% for most people's lines of credit. Whereas if you get a closed variable, then you're usually getting prime minus. Most lenders are only prime minus 0.2 or 0.4. But on a conventional mortgage right now, like a standard refinance, you can get prime minus 0.8 or 0.9 with one lender in the marketplace. They're undercutting the rest of the market substantially. So a line of credit prime plus 0.5, regular mortgage prime minus 0.8 or 0.9, depending on what amortization you choose. That's a pretty big difference. That's 1.3% difference in interest. So even though you get to write off the interest, you still have to pay it, and then you just get a bit of money back at the end of the day. So when you compare those two variables, you might find that yes, my payments are a little bit lower on the line of credit, but I'm paying way less interest on the mortgage, and so people generally opt for the mortgage. The other consideration too is that the fixed rate mortgages lately have been much lower than variable rate mortgages. So the prime rate has moved up a lot more than the fixed rates have, and so locking that in and converting it into, let's say, a 2 or 3 year fixed rate, or especially if you go longer, like a 5 year fixed rate, you get a lower rate, which could actually, in some cases, the payments are almost the same, except now it's principal and interest instead of just interest only. So yeah, there's technically some advantages, but also some disadvantages, and it really depends on what your preference is. Marcos asks, I recently sold my shares in the previous company that I co-founded. I have a fair bit of cash in the bank. I don't have any other income at this time. Would I qualify to buy properties through the holding company or personally if taking money out of the holding company? Good question. So if you have zero income, it's still difficult to qualify. There are some net worth programs where you might qualify for a mortgage, however. So if now you have a lot of cash because you sold the business, then you might be able to find an opportunity here where you could qualify under a net worth program. In general, they like to see some baseline income. To give you an idea of how most of the net worth programs work, is they look at what your income could carry. And if it's very minimal, then that's okay. They just say, okay, you only have a small income source. This is how much it would cover. It'd cover $100,000 mortgage, but you've got, let's say, $2 million in liquid assets. Then you could say, okay, we're going to add the liquid assets to the amount that you qualify for based on your income. And if you've got 2 million in assets, now they say, okay, your $100,000 your income qualifies for, plus the 2 million in net worth qualifies you for about $2.1 million in mortgages. So that's kind of in a simplified way how they would look at it. Every lender has a bit of a different program for it. It's more complex than that, but that's the easiest way to look at it. So it is possible. You could also look at buying it through the holdco as well. If you do that and you're relying on the property's income, then you're probably looking at commercial or small business financing, which means the rates and fees are a bit higher to do that. So it's really case by case, Marcus. I'd say that it's probably good for us to have a conversation about different options there, and that might be a good opportunity to try out Atlas, actually. John has a question. Due to the new 47% corporate tax on passive income, are there any tips or ways to reduce this other than the small business deduction, needing to have 7 employees for this? Yeah, it's difficult for sure. You know what? If you talk to a few different accountants, you're going to get a few different opinions on this. I mean, sometimes the accountants will say, well, if you had a property management business and if you didn't just do property management for yourself, but you did property management for other people, then it may be viewed that you have a property management business, and then that property management company can enter into agreement with your holding company that owns your property, and your operating company could basically just be trying to strip out the positive income out of the holding company, out of the property that, or the company that owns the property. So there are some ways of this, but it is very difficult. And in general, yeah, I've heard 5 employees, 7 employees. It's somewhere in that range. I still don't think it's super black and white, but it is hard to strip out that income and get it completely out. But consider instead, if you were to have a situation where perhaps one entity was renting it from the holding company that owns the asset. So if it's an active company, the active company says, we'll guarantee the holdco $3,000 a month. And then anything that the operating company earns above that is considered income for the operating company. So there's a couple different nuances there. Frankly, though, it's really tricky. Not a lot of people really know where the CRA stance is on this, and there's different stories all over the place. So it is difficult, and it's hard to get away from this for sure. And then Rachel asked, can you repeat the name of the dynamic pricing tool? Is Price Labs. Price Labs. Yeah, it's good. I like it. I'll go into the chat now because I've gone through all the Q&A. Awesome. So, a couple people are saying congrats for the wedding. Thank you, appreciate it. And a few people were saying concussions are hard. Yes, they are. It's really hard because I'm a go person, and the concussion requires me to actually be not so go. So it's been a bit of a challenge for sure, is trying to just take the time and just mend. Let's see here. Are there any other questions? Hatham asks, what if we want to know more about the new Atlas platform? Just reach out, send us an email, and we will be sending an email out to everybody on Tuesday with more information about that. So just stay tuned. If you're like ready to buy something or you really need to move, then just send us an email and then we'll talk, because technically we have it set up in the back end. We're just wanting to have an official launch date and make sure that we write up some more information about how our users can use the platform before we jump. Yes, we will be sending this recording out to attendees so that everybody can look at it and watch it again. And another question that popped up here from Edward: can new immigrants qualify for buying investment property? In general, yes. There's not usually a reason that you couldn't. Usually having enough down payment, etc., is something to consider. As long as you have status here in Canada, then that's fine. Where it could be a little bit more challenging is if you're a new immigrant on a work visa. I believe that the foreign buyer ban may apply if you're buying a rental property in certain areas, and so you'd have to double check a couple of the details there. But if you have full status here, then it should be okay. But that's something you need to dive into. So there are some nuances, and usually it's best to check with a lawyer on those nuances. Although you can also find more information on the internet, or even just send us an email with some more details about your situation, and we can point you in the right direction. All right, I've answered all the Q&A. I've gone through all the chat. Any other questions, anybody? All right, awesome. I'm going to wrap it up. Thanks so much for coming, everyone. It's great to see some familiar faces. Looking forward to seeing you guys again soon. If you have any questions, issues, concerns, anything like that, send us an email, give us a call. We're happy to help and here to help you build your real estate empire. Thanks so much, everyone. Have a good night.